Imagine making your first $10,000 by the time you're 16. Now imagine turning that into a fortune so vast that you're known as the Oracle of Omaha.
1 billion, 2 billion, 3 billion. You can imagine the American economy is.
This is the story of how Warren Buffett, a man who started with nothing, became one of the richest people on earth. And no, it wasn't just luck. But here's the kicker. Buffett did it in a way that most people wouldn't even think of. And he did it without succumbing to the traps that have taken down so many before him. This is how Warren Buffett got rich. Warren Buffett was born in 1930 during the Great Depression, hardly the ideal time to start dreaming of millions. But young Warren was different. By age 6, he was already making money selling packs of chewing gum and bottles of Coca-Cola. By the age of 11, he made his first investment, 3 shares of Citi Service preferred stock. But when the stock dropped, Warren learned his first valuable lesson: patience. He sold too soon and missed out on a major profit when the stock rebounded. This experience would lay the groundwork for his entire investment philosophy. The power of compounding, slow and steady. By the time Warren hit his teens, he was already obsessed with the stock market. He understood something that few people grasp at such a young age: the power of compounding. He knew that even small sums could grow exponentially over time if reinvested wisely. While most kids were out playing, Warren was busy reading financial reports, studying companies, and learning everything he could about investing. He realized that the key to wealth wasn't in quick wins, but in steady long-term growth. His philosophy? Buy businesses, not stocks. And he did just that, starting with small investments and reinvesting the returns. The mentor, Benjamin Graham, and value investing. Warren's life changed forever when he attended Columbia Business School and met his mentor, Benjamin Graham, the father of value investing. Graham taught Buffett the principles of finding undervalued companies, ones that were selling for less than their intrinsic value. Graham's philosophy was simple: a stock is worth more than its price tag. Warren took this to heart and began hunting for bargains in the stock market, companies that were undervalued but had strong potential for growth. But the real turning point? It was a company called Berkshire Hathaway, a failing textile mill that Warren bought into in 1962. The investment didn't look like much at first, but Warren had a vision. He saw an opportunity to transform it into something much bigger. Instead of sticking to textiles, Buffett started using Berkshire as a holding company to buy businesses he believed in: insurance, banking, consumer goods. He wasn't just buying stocks anymore. He was buying entire companies. And with every acquisition, his wealth grew exponentially. Warren's success didn't come from chasing the latest trends or trying to make a quick buck. He did it through patience, discipline, and a commitment to the long game. His rules: never lose money, don't invest in what you don't understand, and focus on companies with an economic moat. These are companies that, even when facing fierce competition, could maintain their profitability and market dominance. Think of Coca-Cola, a brand that even in the face of countless competitors has remained synonymous with soft drinks. Buffett understood that these moats were what kept competitors at bay and allowed a business to thrive for decades. Another crucial element in Buffett's strategy was his long-term perspective. In a world where investors are obsessed with quarterly earnings and daily stock prices, Buffett played a different game. He famously said that his favorite holding period is forever. By focusing on the long term, Buffett avoided the noise of short-term market fluctuations and instead concentrated on the enduring value of the businesses he owned. This patience is what allowed him to benefit from the power of compounding over time, turning good investments into great fortunes. These principles guided him through the ups and downs of the market, allowing him to build a fortune that today stands at over $100 billion. But more than that, Warren Buffett became a symbol of what it means to be a smart, ethical, and long-term investor. Of course, Buffett didn't achieve all of this on his own. His partnership with Charlie Munger, his longtime business partner, was instrumental. Munger's sharp mind and contrarian thinking complemented Buffett's own approach, leading to some of Berkshire Hathaway's most successful investments. Together, they created a dynamic duo that could spot opportunities others missed. and their combined wisdom became a cornerstone of Berkshire's success.
Let's go to number 6.
Hi, my name is Timothy Ferris. I am a guest lecturer at Princeton University twice a year. And I'd like to touch on an earlier question about investing with small sums of money. I'd like to ask both of you, if you were 30 years old again and had your first $1 million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents, and it'd be really helpful for my students, for myself and others here, if you could be as specific as possible about asset classes, percentages, whatever you're willing to offer.
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard. Somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this hasn't been, I would feel that that was going to outperform to a degree bonds under current conditions over a long period of time, and then I'd forget it and go back to work. Charlie?
Yeah, it's in the nature of things that you aren't going to have a whole lot of screamingly successful professional investors. You've got a great horde of professionals taking croupiers' profits out of the system, most of them by pretending to be professional investors. And that is in the nature of things too. But if you don't have any rational prospects of being a very skilled professional investor, well, of course you should compromise on some simple thing like an index fund.
Yeah, and that you will not get that advice from anybody because nobody gets paid to give you that advice. And so you will have all kinds of people telling you how much better they can do for you than that, and how if you just give them a wrap fee or give them commissions or whatever it may be, that they will do better, but they won't do better. On average, 1,000 other people like you do the same thing. That group of 1,000 will do worse if they listen to the people that make pitches at them. And in the end, why should you expect? I mean, you'll get a perfectly decent return over a 30 or 40-year period by doing what I suggest. And why should you expect more than that when you don't bring anything to the party? The salesman will tell you that you'll get it, but you won't.
Buffett's journey from a small-town boy to one of the richest men in the world is a testament to the power of disciplined investing. But even more impressive, his commitment to giving it all away, pledging 99% of his wealth to charity. Warren Buffett didn't just get rich, he changed the way the world thinks about wealth. Buffett's philosophy extends beyond just investing. It's about life. His focus on living simply, staying true to one's principles, and giving back to society has not only made him one of the wealthiest men in the world, but also one of the most respected. Buffett's decision to donate the majority of his wealth to philanthropy speaks volumes about his character and his belief that wealth is only as valuable as the good it can do for others. And that's how Warren Buffett got rich. If there's one thing Warren Buffett continues to do well into his 90s, it's that he keeps learning. Knowledge acquisition combined with action is powerful. If, like Buffett, you want to keep learning new skills and use them to build your own financial success, check out Skillshare. Real-life entrepreneurs like Ali Abdaal, Thomas Frank, Sorella More, and MKBHD share their expertise on the platform. Click the link in the video description for your first month free. If you found this video valuable, hit the like button, subscribe, and check out our video on whether crypto will soon replace money as we know it. Don't miss out. Knowledge is power. Not knowing what will happen to money could mean the difference between poverty and wealth.